Hey everyone, today we're going to go over chapter 3. I'm going to do this webcam recording and you'll be able to see me down in the bottom corner. But I'm going to go through the slides together with you guys, and then we're going to go over a few of the problems together, and then you guys are going to do the rest independently. So hopefully this will help you out as you're going through chapter 3. Here we go. So chapter 3 is all about business transactions and the accounting equation. The accounting equation is up on the wall to probably, some of you are facing it and some of you have your back to it, but we'll talk about it in a second. So it's up on above the bulletin boards there. But the main idea for chapter 3 is that any item of property has at least one financial claim against it, and we'll talk about that more. Accounts are used to analyze business transactions, so as we are looking at how a business spends money or brings money in, we're putting those transactions into specific accounts. And then from there, owner's equity is changed by revenue, expenses, and withdrawals. All right, so property is anything of value that a person or business owns. So when you're looking at property that a business owns, it's going to include, if you're looking in the classroom, it would be the desks, the chairs, the whiteboards, the bulletin boards, the cabinets, anything that is actually owned by the business. A financial claim is the legal right to that property. So let's say that I bought all these tables in my classroom and I had to borrow money from the bank to buy them. The bank owns the tables because I borrowed money from them. As I pay the bank off, that financial claim transfers to me. So two or more people could have financial claims to that property at the same time, and that's where like lien processes come into play. But for this class, we keep it pretty simple where it's either the business owns it, the bank owns it, or they share the financial claim. So the amount of property should equal the amount of financial claims. If I bought the tables for $20,000, the financial claims should equal $20,000. So let's say the bank paid for 15,000 of the tables and I paid for 5,000. Those financial claims would equal the whole 20,000. So credit is when you buy something and agree to pay for it later. It's when they lend you money, and the creditor is any person or business to whom you owe money to. So again, in my example for the bank would be the creditor. It could also be the business that I bought the tables from. I can finance through them. It could be a credit card. So there's lots of different creditors out there. So this just shows you an example of kind of partly how the accounting equation is set up. So we've got the bike lock, which is our property, valued at $100. The financial claims would be the creditor's financial claims, so you had to borrow $40 to buy the bike lock, and then the owner paid for 60 of it. So 40 plus 60 equals 100. So if you look up on the wall, you'll see where it says assets equals liabilities plus owner's equity. So assets include all of these things in the circle: land, cash, office equipment, manufacturing equipment, buildings. Lots of things can go under assets, but basically it's just the property or items of value owned by the business. From there we have our owner's equity, and this is the owner's claim to the assets of a business. So if we go back to that bike lock scenario, it's $60 of the bike lock is owned by the business owner. That's the owner's equity. So liabilities are going to be the amounts owed to the bank or the creditors. So a liability is just what you owe someone else. If any of you guys have auto insurance, you probably have liability, and it just means that if you are in an accident and you hurt someone else or damage someone else's property, that's the amount that you owe them. So it's just liability. It pays for somebody else. In this scenario, it's what somebody else actually owns of the property. All right, so let's get into business transactions. This is an economic event that causes a change, either an increase or decrease in assets, liabilities, and or owner's equity. We will always have one side or two items being affected, whether it's increasing or decreasing. And so I'm going to give you some examples of business transactions here in a little bit. But as we are looking at the assets, liabilities, owner's equity, we have different accounts which we subdivide under all of the assets, liabilities, owner's equity. And again, I'm going to show you how this works, so don't freak out yet. It feels like a lot of information, but you guys will have a lot of practice and you'll get the hang of it. So two of the big ones, we have accounts receivable and accounts payable. Accounts receivable is when you plan on receiving money from somebody else later. So you sold something to them and they're going to pay you back at a later date. Accounts payable is when you're going to pay someone at a later date. So it could be the bank, it could be the credit card, it could be the business that you purchased the tables or that bike lock from. It's just when you owe somebody else. So accounts payable is always going to go under liabilities, and accounts receivable will go under assets. And I just went over that. So, all right, so these are the first 4 steps in analyzing your business transaction. First of all, you're going to identify the accounts affected. You'll then classify the accounts affected into asset, liability, or owner's equity. You'll determine if they increase or decrease. And then you're going to make sure that the accounting equation remains in balance. So this is going to be the typical first business transaction that you'll see as we get going through the assignments in this class. It will most likely always be an owner investment, and this is just saying that the owner put money into the business. So it says Krista Vargas took $25,000 from personal savings and deposited that amount to open a business checking account in the name Zip Delivery Service. So you can see here that Krista Vargas has an addition of $25,000 and cash increased by $25,000. Now what's important here is that on the both sides of the equal sign, we've got a plus and a plus, meaning our equation is in balance. So transaction number 2, it says Krista Vargas transferred 2 telephones valued at $200 each from her home to the business. So again, Krista put something of her own into the business here, and telephones go underneath office equipment. These are our accounts that we are subdividing our classifications into. So our office equipment is increasing and our capital account is increasing. And again, on each side of our equal sign here, it is now equal. Zip issued a $3,000 check to purchase a computer system. So this is an example of when only one side of the accounting equation is affected, because we paid for the computer system, but we actually gained the computer equipment. So computer equipment increased and cash and bank decreased, and if we were to add these up, it would still equal $25,400 on both sides of our equal sign here. Again, guys, you're going to have lots of practice with these, so if you're like feeling really stressed out about it, that's what's great about this video, is you can come back and look at these. But these are all right in your book. You can see on page 59, that's where we're at in our textbook. All right, so here's a transaction where we purchased something on account. So Zip bought a used truck on account from Coast to Coast Auto for $12,000. So we bought delivery equipment, that's going to increase, and we bought it on account. Anytime you guys see it says on account, it means that either we purchased something and we're going to pay for it later, or somebody purchased something from us and they're going to pay us later. So it's always accounts payable or accounts receivable. And in this case, we bought something from another company and we're going to pay them back later. So it's accounts payable. So you'll see here that the delivery equipment increased and our accounts payable is going to increase. This is where a lot of people kind of get mixed up, because they're like, well, why is this increasing? We still owe them money. As we pay that money down, so let's say we paid $1,000 in the next transaction, our cash and bank would decrease by $1,000 and our accounts payable would decrease, because it would show that we owe them less money. And I think that it gives you an example here. So moving into revenue and expense transactions. So revenue is income earned from the sale of goods or services. So this is any time that our company is making money. It could be fees, it could be the sale of merchandise. We start out looking at service businesses. So typically anytime you see the word fees, that means that we are charging somebody a fee to do something and we are making money, which is revenue. Examples of expenses include rent, utilities, advertising. These are just the costs of operating a business. A withdrawal is when the owner takes cash out for personal use, and it's going to decrease our owner's equity. So if they take cash out, cash will decrease, owner's equity would decrease. Alright, so I'm going to pause here, and I'm actually going to start another recording so you guys don't have to watch this whole thing over and over again to go through the problems. But we're going to do problems 3-1 and 3-2 together today. Tomorrow I'll post a video with 3-3. Again, this was like fast and furious for you guys, but feel free to come back and watch this video. We'll have lots of practice with this, you guys. Don't freak out about it. If you're still feeling a little like I don't know what's happening, we're gonna have a lot of practice. So stay tuned. I'm gonna separate these problems out again just for your sake, so you don't have to watch this whole thing. So move on to the next video. See you guys.